Hey everyone, I'm Jeremy Szafron. You're watching Kitco News. Don't forget to subscribe to our channel for the latest updates. Now today we're breaking down the latest U.S. economic data, which revealed some challenging dynamics. The economy expanded at a modest 1.6% annual rate in the first quarter. That's its slowest pace since mid-2022. Now this deceleration is largely due to a significant jump in imports and a minor accumulation of unsold goods. Adding to the complexity, the personal consumption expenditures, or the PCE price index, a key indicator of inflation closely watched by the Fed, increased at a 3.1% annual rate, intensifying from 1.9% last quarter. Now, after the data was released this week, investors are pricing in only one rate cut this year in September. That's according to the CME FedWatch tool. Now, UBS also saying here that there's a real risk of the Fed raising rates to 6.5% rather next year. Now, to help us understand what this means, we welcome Kristina Hooper, the Chief Global Market Strategist in Invesco, joining us today. Kristina, thanks for coming on the show.
Thanks so much for having me.
Yeah, I want to start a little bit here, getting your reaction to the latest PCE data. The core PCE price index increased at an annual rate of 3.7% in the first quarter of the year, significantly above the Fed's target of 2%. And additionally, on a monthly basis, the index rose by 0.3% in March, matching the increase from February. I guess the question is here, were you surprised by any of the data?
Well, not too surprised. Once we got the quarterly number, we knew it wasn't going to be great to get today's report. And I have to say, though, it was slightly better than I think markets anticipated. So that's the positive there. But the reality is that in the recent inflation data we've seen, and this has been a few months now, has not been a great trend. So I have to admit that. But having said that, it can change rather quickly. And so I anticipate that we could very well see in the coming months better data that convinces the Fed that it can start to cut rates, even if it does so gently.
Interesting. Let's unpack that a little bit more, Kristina, because yesterday you sent a tweet out that said, I still believe a Federal Reserve rate cut in June and a total of 3 cuts of this year are very, very possible, but markets need some more data to change their minds. Is this the data that you were talking about? Has your mind changed here?
So this is not the data I was hoping for or talking about, for sure. And so it seems far less likely that we're going to get to a June cut, although I still think there's a tiny chance of it. I mean, keep in mind, if you go back to June of 2022, the Fed had messaged it had signaled for several weeks before that meeting that it would be hiking rates by 50 basis points at that meeting. And instead, they came in surprised and hiked rates by 75 basis points. And when asked what did it for the Fed, it was 2 data points that they had received within days of the actual meeting. It was Michigan inflation expectations and CPI. So data can change the Fed's mind, and it doesn't have to be a lot. Now, of course, I think they were erring on the side of caution. No one wants to be another Arthur Burns in terms of a Fed that let inflation get a little out of control. So certainly the Fed is more sensitive to letting inflation get out of control than it is sending an economy into recession, especially if the data looks good. But I give you that illustration just to say there is the possibility that you could have strong enough data that could change the Fed's mind. And so perhaps it's far more realistic to say there's a real possibility of a July rate cut. I still hold out hope, a lot of hope for that.
Interesting. So you're calling for July.
I'm still saying 5% chance in June.
Okay, I see. Okay. We were just talking a little bit about, the numbers that were being released, and you said that you were actually surprised that they were better than anticipated. Not saying too much, but Treasury Secretary Janet Yellen just, I think today, commented on the weaker than expected data on the first quarter output. She believes the U.S. economy is performing, quote, very, very well, and that inflation will return to normal levels. Given the contrast between her optimistic outlook and the recent GDP figures showing, the 1.6% growth rate, why do you think she's so confident about the economy's strength?
Well, I think she's seen a lot of very positive economic data and not
Hmm.
too many data points that suggest the economy is slowing. But I think the reality is the economy is slowing, which is what the Fed wants to see.
Right.
Of course, the slowing of the economy, this disinflationary process are all very imperfect. And so you may see data points that aren't necessarily what you want to see, but the trend certainly suggests that we're moving in the direction that the Fed wants on both counts. So, certainly, Treasury Secretary Yellen also wants to be a cheerleader for the US economy. So, I don't think she's going to
Hmm.
talk it down. But we are seeing more stress on consumers. If we look at credit card delinquencies, if we look at the percentage of those that are giving minimum payments in terms of servicing their credit card debt, those all suggest that stress is increasing.
Hmm.
And I think that will continue. One could argue that perhaps it's a two-speed economy, and that there are significant portion of households that are still doing very well, and another portion that aren't. But I think it will spread. I don't think it's going to be a severe slowdown, but I think of it as more of a bumpy landing.
Yeah, no, that's a good word to use, bumpy landing, a good sentence. I mean, the labor market seems to remain really robust here. Consumer spending continues to drive the economic activity. It almost seems like jobless claims have fallen and employment remains strong. So I'm kind of curious, with the spending growing at a 2.5% rate last quarter, is there a potential for these positive trends in labor consumption to offset the negative impacts of imports or these buildups that we're talking about?
Well, that makes the assumption that the labor market stays as strong as it does today, and
Right.
as it is today. I think that is a big assumption to make. We've
Hmm.
already seen an increase in unemployment over the course of the last months, and we could very well see an increase from here. And that, of course, will impact the ability to spend. That will impact the ability of consumption to be a countervailing force. So I would argue that what we're likely to see again is more data that shows a cooling of the U.S. economy. Not
Hmm.
dramatic, but the risk is that the longer that we keep rates as high as they are today, the more likely there's going to be significant damage to the US economy.
Yeah, we talk about that inflation and the costs on consumers. Given the Fed's dual mandate, at what point, Kristina, do you believe inflation risks may justify a shift in policy here? Maybe the focus from supporting employment to controlling price levels more aggressively.
Well, I think the Fed has done a lot of work to
Yeah.
control prices, and that they're getting close, in my opinion, to having risks be rather balanced, where they have to worry more about the potential for recession. Now, of
Hmm.
course, that will come into greater focus as we get more data through the second quarter of this year. But I think that could very well be the picture that forms, and that we don't see, very sticky inflation. But what we do see is an economy that's slowing enough that the Fed thinks more about and is more inclined to start cutting rates.
Yeah, I mean, we're all hoping for those days eventually here. The first quarter of 2024 saw a significant surge in imports, and this contributing to a widening trade deficit that negatively impacted the GDP. The long term implications of these dynamics could be quite multifaceted for the US economy. I'm just a little bit curious here when we talk about this. Elaborate on how trade dynamics and, these imports coming in might really affect growth strategies for the future.
Well, I think there are going to be a lot of factors that impact growth over time. So
Hmm.
I would point to areas like artificial intelligence as something,
Yeah.
and technological innovation, investment as something that can be a real boost to growth over time. Um, one could argue that what we see in terms of the economy going forward, and one of the biggest issues facing the U.S. economy in the past and other Western economies has been a lack of investment that has led to lower productivity, that has impacted growth. And so that the greatest thing that could happen to the U.S. economy could be investment in areas like innovation that can greatly improve productivity. We just haven't seen the total factor productivity burst that we saw in the decade between 95 and 2005. We haven't seen anything like that. And I think that with the advent of artificial intelligence adoption and investment in those areas, we could very well be realizing a similar or even better period for total factor productivity.
Yeah, fascinating time. I mean, tech giants Microsoft and Alphabet both beat analyst estimates when they reported their quarterly earnings this week. Alphabet shares surged as much as 12%, hitting their highest levels ever and pushing Alphabet's valuation past the $2 trillion mark. I think Microsoft rose around the 3.5%. We keep seeing robust growth in cloud computing revenue, driven significantly by this whole AI community, as we keep talking about. Is AI going to be the main driver of economic growth in 2024?
I don't know if it's going to be the main driver of economic growth in 2024, but it certainly is laying a foundation for a role as a significant driver of economic growth for years to come. What it could very well be in terms of a driving factor is, again, popularity of specific stocks. If we look at earnings calls, I think the references thus far this season have gone down a little bit. But just the vast number of companies that have referred to artificial intelligence in their calls is quite breathtaking. And I think harkens back to the late 90s and the adoption of the internet and that kind of excitement that it created. Some would argue a little too frothy excitement, given the particular stock, but it certainly is driving interest and excitement and enthusiasm for a number of different stocks.
Now, talk to me a little bit about investment strategies here. I mean, are we going after the picks and shovels? Maybe we're not buying Alphabet. Maybe we're not buying Microsoft. But where is the strategy here? If this is going to set us up for some future potential of returns over the next few years, what is your strategy? What would you recommend for investors to watch out for here?
Well, we like to take a long-term view because most investors have a longer time horizon. And so that means, unlike real estate where it's location, 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 it's all about diversification, diversification, diversification. And so it's very, very important, I think, to make sure investors have adequate exposure to those areas that they may be underexposed to after years of outperformance by, for example, large caps, by growthier parts of the market, by technology. So having adequate exposure to smaller caps and cyclicals, because we do know that at a certain point, the Fed and other central banks will start cutting. And that could very well be the beginning of a reacceleration in economies. And that typically leads to, or in fact, stocks discount that in advance of it happening. And so we tend to see small caps perform better. We tend to see cyclicals perform better because they're arguably benefiting from that reacceleration in the economy. So I think it's important to have exposure there. And of course, investors can become too concentrated in areas like the U.S. because the U.S. has performed well. So taking that sort of inventory of one's portfolio and ensuring exposure to emerging markets, which could benefit from a weakening dollar when that starts to happen, which can benefit from growth dynamics just in the emerging market space, longer term, driven by things like demographics. So I think being well diversified across and within asset classes, and that of course includes adequate exposure to fixed income. I think investment grade credit is a sweet spot right now, but also exposure to emerging market debt, I believe makes sense if one has a long enough time horizon, and then having some alternatives, areas that aren't closely correlated with other major asset classes.
Talk to me a little bit more about the emerging markets and what you're seeing. I mean, it's an interesting year, 50% of the population going into elections this year. Where are you looking to in the emerging market space? Is there any particular countries as we continue to see economic data being released from global places?
Well, I think there are a lot of opportunities in emerging markets, but let me focus in on Asia EM because I
Hmm.
think there is a significant opportunity in that space. Demographics in a number of Asia EM countries look really good. Now, India valuations are high, but there is significant growth potential. Other economies have lower valuations. Their markets have lower valuations and somewhat similar demographic profile. And of course, I think there's this benefit that will come from a Japanese economy that's quite good,
Hmm.
a Chinese economy that looks poised to reaccelerate. And of course, as we know, supply chains have diversified, so there's more participation by different countries in Asia. So that's just one example of many, but I think that emerging markets is an area with significant potential. Uh, Given if one is patient enough, because I don't know if it's going to happen overnight, but I think
Yeah.
even looking out 2 years, I think there's a lot of opportunity there.
Okay, what about the US in terms of just a forecast before I let you go? I mean, we see a little bit of a pullback on the S&P, but it seems like there's still a lot of breath in this market. Has anything surprised you? What's your forecast going towards the US equity market this year?
Well, I wouldn't be surprised to see more of a pullback. I
Yeah.
don't think we are going to see very strong sentiment until we get better data that suggests the Fed can start to cut rates. But I think it's important to note that this is an area in which, while valuations can be extended in general, there's a lot of attractive value opportunities
Mhm.
within the US market, including solid dividend payers. So I think that we're likely to see continued increase in breadth, and that's a good thing. That's something that suggests we're going to see a reacceleration in the economy.
Christina, one more question. I want to talk a little bit about gold. I mean, we've had the World Gold Council talk about the central bank demand in China and India. It's increasing. It seems as though consumers are going. Costco's selling millions a month. Talk to me a little bit about what's happening in the gold market as, the geopolitical concerns are out there and continue to be.
Well, it just seems like there is a confluence of factors driving this popularity in gold. I think first and foremost, we of course have these central bank purchases, and a lot of that has to do with concerns, bond vigilante concerns, right? Will there
Hmm.
be enough buyers of U.S. Treasuries? Is the fiscal situation in the United States sustainable? So that's certainly one driver. Another is just that gold has emerged, and I think this is related to that. Gold has emerged as the geopolitical risk hedge of choice. And
Hmm.
and that has happened over several years. And so as geopolitical risks grow, and we've seen popularity in gold grow, and when we go back and look early in the last decade when US debt was downgraded and there was a real risk off reaction, we saw investors flock to US Treasuries, even though they were the asset class that had been downgraded. And I think
Hmm.
that speaks to just how US Treasuries used to be the you know, risk hedge of choice, the safe haven asset class of choice. And that really has changed a lot. Certainly, it's still something of a safe haven asset class, but gold has really taken a bigger role and has become, I think, the preeminent safe haven asset class of choice. And then, of course, you have, a lot of countries believing that the United States has weaponized the U.S. dollar through
Hmm.
sanctions.
Hmm.
And so I think there's a real reluctance to get close to anything like the U.S. dollar, anything like U.S. Treasuries. And I think that also, of course, has fueled more of an interest and desire to own gold.
Yeah, it's been fascinating to watch. Do you have a price forecast for gold here going into the year? You're talking about supply and demand. I mean, demand's not going away here. Are we going to see these increase in gold prices?
So I don't want to give you the false precision of an actual target, but I will
Yeah.
say I believe directionally it's going to move higher. Think of all the elections we have this year. Think of all the potential geopolitical risks, as
Mhm.
well as the natural desire of central banks to buy gold. And then, of course, with Costco selling gold, who knows how much higher it'll go.
All right. I appreciate it. Kristina Hooper, of course, the Chief Global Market Strategist at Invesco. Thanks for joining us today, Kristina. I really appreciate your time and your insights. You helped me understand a couple things here.
Thanks so much for having me.
Appreciate it. I'm Jeremy Szafron for all of us here at Kitco News. Thank you for watching. Don't forget to subscribe to our channel, and we'll see you next time.